Welcome. Welcome once again to the Innosight webinar on improving your innovation success rate. This is Evan Schwartz. I'm your moderator and the Director of Storytelling here at Innosight. I'm pleased to introduce our presenters today, Scott Anthony and Dave Duncan. Scott is the managing partner at Innosight and is based at our Asia Pacific headquarters in Singapore. Dave Duncan is a senior partner at Innosight based in our U.S. headquarters here in Boston. Scott and Dave are the co-authors of Building a Growth Factory, recently published by Harvard Business Review Press. This short ebook presents insights and case stories from Innosight's innovation capabilities practice. We want to hear from you, so we'll be taking a couple breaks to answer questions. Just type yours in the dialog box. It's located in the control panel in the upper right corner of your screen. No need to raise your hand by pressing that button. Just type right in. I'll be collecting the questions and posing them to Scott and Dave. And now I turn it over to Scott Anthony.
Thank you very much, Evan, and good morning, afternoon, or evening, depending on the time zone that you are joining us from. We're very excited to be with you today to share some of our thoughts about this topic of improving your innovation success rate. Let me start just by saying a couple words about Innosight. There's really three things I want to highlight from the things you see on the page here. The first is we are obsessed with this problem about how you improve your innovation success rate. I'll share with you a few statistics around this in just a minute, but it is a critical challenge facing companies. The second point is the reason why this matters is because companies increasingly feel the need not just to incrementally improve their business, but really transform their business in the face of all the changes going on in the world economy. Final point, as we've really thought about this topic of transformation, we've realized that you can't solve it simply through coming up with a great idea. You need to have the right strategy, you need to have the right capabilities, and you need to accelerate a short list of growth opportunities. We're going to focus our discussion today on the capability side of the equation, but we recognize it's only a piece of the problem, and we'll talk about the other areas as we go through today's discussion. So let's talk just a little bit about the nature of the challenge. The way that I framed it up on the slide here is by having four images. Let me walk through them starting on the top left image on your page. The gentleman who is pictured there is Bob Johansen. He's from the Institute for the Future. He is a futurist. He looks 10 years into the future to predict what the world will look like. He's been doing this since 1968, meaning he has outlived a number of his forecasts. In his recent book, Leaders Make the Future, he borrowed this term from the Army War College to describe today's environment. We're living in a VUCA world. It's volatile, uncertain, complex, ambiguous. The only thing that Bob said he could predict with certainty is we're going to see more of each of these things in the years to come than we have ever experienced before as a planet. What does this mean inside a corporation? Well, let me give you a couple statistics. 75%. These are the percent of companies on today's S&P 500 index that if current trends hold will not be on the index in 2027. They will stumble. They will be acquired. They will be overtaken. This is the reality of corporations today. Greatness lasts for an increasingly short period of time. Now, one of the reasons why this happens is because these great new startups seemingly come out of nowhere and transform organizations and industries. But it's no easier being a startup. The picture on the bottom right of the page is Facebook when it issued its stock to the public. Now, there were a couple bumps after the IPO of Facebook, but it's still remarkable that you have a company that went from nothing to a $50 billion enterprise in less than a decade. This is an anomaly. 75%. That is the percent of venture capital-backed startups that do not return a single dollar to their investors, let alone exponential returns. The final picture on this page is a little bit more personal. That's my daughter, Holly, using her Dora the Explorer laptop. 95%. That is my own estimation of the probability that when Holly enters the workforce, that she uses something other than a laptop in order to compute. Whether it's done through touch, it's done through her mind, who knows? But the dominant technologies of today will not be the dominant technologies of tomorrow. The world is just changing too fast. This is why this is such a critical problem to work on, given all the uncertainty in today's environment and all the change we all face as leaders. I've got my colleague and co-author Dave Duncan here with me today. Dave, I wondered a little bit of your own perspective about how you feel this change taking place in the marketplace. You see it and feel it as well.
I do, and I would just add 2 quick points to what Scott has teed up for us. The first is that this is truly a universal phenomenon. You see every company in every industry facing this same challenge of accelerating change and uncertainty and disruption. And while you might see variation from one to the next in terms of how quickly things are changing or how far advanced industry disruptions have become, you still see it, and it's quite pronounced, and it's something on every leader's mind. And this really sets up the fundamental challenge that we're going to be talking about through the rest of this webinar, which is that if you're a company and you want to survive, and not only survive but thrive, it means that you need to figure out how to evolve. And this means that even while you're spending most of your energy and resources focused on strengthening and extending the businesses that you're in today, you have to simultaneously be planting the seeds of the businesses you're going to be in tomorrow. And doing these things at the same time is extraordinarily difficult. And but it's a necessity if you're going to adapt in this rapidly changing world. And that's really what we're going to be talking about for the rest of this webinar.
Excellent. Thank you, Dave. You heard from Evan in the beginning that we're going to try to make this as interactive as we can. One way to do this is to get perspectives from the audience about where you're feeling pain. So we'd love to run a quick poll now. Kristen, maybe you can bring that up on screen, that asks you how satisfied you are with your return on your innovation investment on a scale of 1 to 5. So just go and click the option that you think best fits your circumstance, and let's see what the audience has to say. We'll just keep this up here for another 10 or 15 seconds or so. Okay, you want to show us the results, Kristen? Well, I'm very happy to see that very few of you are ready to give up. If too many of you were ready to give up, we would have a very short discussion here. But you see something here that's very consistent, again, with what we see in the field, where you've got about 80% of you who gave it either a 2 or 3, where you're either dissatisfied or not particularly pleased. It's a real problem. We make investments in innovation. We know it's critical to overcome the challenges we're facing, but we just don't get the returns that we seek. Now, we've been studying this problem for a while, trying to figure out why is it that smart people end up having this dissatisfaction. This is the way that we'd like to frame it up. This is a disguised example from a company that probably many of you know that tried to solve this problem. They called us up a few years ago and they asked us, could we help them to design and implement an innovation challenge where they would go and ask all of their employees to come up with ideas to create new growth businesses. We ended up not actually getting the project with them, partially because we told them they had asked the wrong question, that if they only did an idea challenge without the right systems around it, we didn't think it was going to have much impact. Well, in late 2012, I got an update on the program, and this is roughly what the update said. Now, you can read through all the corporate buzzwords in here talking about how there are sparks and more than 1,000 ideas were submitted and the fire still burns. But if you read through this carefully, you recognize that the actual impact the company got from this program was absolutely 0. And this is not a single example. We've seen this again and again. People try to do a thing, and the thing doesn't solve the problem. So there are a bunch of ways that you can think about trying to address the innovation challenge. You might have a hackathon. You might bring in a creativity consultant who's dressed in a silly outfit. You might borrow from Procter Gamble, who we'll talk about in a bit, and open up your innovation efforts. You might have incentives. You might have contests. You might create skunkworks divisions like Lockheed Martin or a venture capital arm like Intel. These are all really good things to do, but on their own, they are insufficient. As we think about the challenge of innovation and growth, we cannot solve it with a single point solution. So what I'm going to do now is turn the mic back over to Dave to talk about our thinking about how you actually can address this challenge.
Thanks, Scott. And just to build a little bit on what Scott was just describing, these point solutions are responses to what I would say are point diagnostics of what the core issues are. And as we've worked with hundreds of leaders of large successful companies over the past few years, and we hear them describe the challenges in their own words that they're facing to grow through innovation, we consistently hear the same set of issues come up again and again. I'd say there are between 20 and 30 things that we hear over and over, but you'll hear a different subset of them from one person to the next, and they'll include things like, well, we just need to get our culture to become more innovative. We need our people to be more embracing of intelligent risk-taking and more creative and experimental. Another might say, well, we've just got the same kind of set of stale ideas floating around that we've had for years, and we need some new, fresh ideas. Others might say we've got plenty of great ideas, but the problem is really about execution. And you can see how that type of a diagnosis could lead to some of the initiatives that Scott just described as potential solutions. And what we've come to understand, though, is that, in fact, all of these answers are both correct and taken by themselves, though, that they're incomplete. All of these issues are important, but what you really need is a whole system of enablers in place in order to enable sustainable growth through innovation. And because you need a whole set of things, and they all need to be working together in an integrated way, it's precisely why it's so difficult to pull off. So what we'd like to do is first share with you how we think about what the system needs to look like and what some of the components of it are. And we found the metaphor of a factory to be a very helpful one in both explaining what the different components are and also what the nature of the system needs to feel like. And the way we use this factory metaphor is just like a manufacturing facility or factory exists to create and spin out repeatedly different types of widgets. What you want to be trying to establish in your organization is what we call a growth factory, which exists to create and commercialize new sources of growth. And the factory metaphor connotes that there's a degree of precision and predictability and control that we believe is possible in innovation for new growth if you manage it correctly and you set up your factory in the right way. And there are four primary components of a growth factory in the way that we think about it. And I'd like to introduce each of them at a high level here, and then we'll get into them in some more detail and share some specific examples. The first component of the growth factory is what we call a growth blueprint, which is your plan for how you are going to grow. In a real factory, you need a plan as well. You need a blueprint that's going to define what types of widgets you're going to produce, in what quantities, and when those are going to be coming out of your facility. In a growth factory, you need answers to analogous questions. Where is your growth going to come from? How much do you expect from different types of growth? And then when is it going to impact your top and your bottom line? We'll get into that in a little bit more detail. Once you have your plan for how you're going to grow, what you're going to create, well, then you need the means to create it. And so the second component of this factory is what we call production systems. These are the processes, the organizational structures, tools that actually carry out the innovation. They're analogous to the assembly lines or production lines in a factory that's creating tangible things. Just like those convert raw materials into things that you can sell, the production systems in a growth factory transform the raw materials of innovation, which are ideas, into new sources of growth. The third thing you then need is people. People to run your production systems, people to oversee the whole ensemble, and a culture that supports and enables that to continuously happen. And then finally, what you need is a kind of overlay layer of management systems for managing all of that, which we call governance and controls. And this includes things that enable you to allocate resources to different assembly lines in your production systems, to assess whether you've got things coming out in the right balance, to assess the efficacy of your factory, and to make adjustments over time. So that's an overview of our how we think about the elements of a growth factory. And then just to go into slightly more detail, And this is, again, a kind of intermediate level of detail. We can go much deeper than this. But each of these four components has a number of enablers that we've come to understand over time needs to be there. And we'll go through them each in detail with some specific examples, but just to highlight a couple of the most important components. In the growth blueprint, one of the most important things you need to do is to define where your sources of growth are going to come from. And we refer to that as growth types or innovation types, and this is really a foundational thing that needs to be in place. For the production systems, you need to define distinct structures, processes, resources then that align against those growth types and enable each of them to be produced with a distinct set of processes and metrics and systems. In the governance and controls, the most important thing is to have resource allocation systems that enable you to balance across these different types of growth. And then finally, in the leadership, talent, and culture component, you need leadership playing the right roles, you need the right teams with the right skills, and a number of components built into your HR and people management systems that support all of that. And I'm going to turn it over to Scott now to go through a specific example to make that more concrete.
Thanks, Dave. And I'll just draw attention to one extra thing on this page before we get into our example. So you heard Dave talk about all the key components here. The leadership word was used a few times because we've come to understand how absolutely critical this is to really make innovation a repeatable discipline inside a company. Most companies are built to execute. They are not built to innovate. They're built to run today's business model, not create tomorrow's business model. Now, the way to solve these problems, either at the level of an individual initiative or the systems you see here, are actually pretty well defined. Because you are butting up against established systems, if you don't have top leadership actively involved, it can be very difficult to make progress. So I think that's something that is worth drawing extra attention to because it's a critical component here. So let me give you one case study of a company that's thought about building its own growth factory. And then we're going to pause and answer some of your questions. I see a lot of great questions have been coming in already. Please continue to send them in, and we'll try to get to as many as we can during the couple breaks that we have planned. And if we can't get to them during the discussion, we'll try to answer them afterwards. So the company I'm going to talk about for just a minute or two is Procter Gamble. Now, most of you probably know Procter Gamble. It is the world's largest consumer packaged goods company. It has a market capitalization of more than $200 billion. It invests quite heavily in innovation. Invests more than $2 billion a year in research and development, invests about $400 million a year in consumer research. It's something that the company has always considered as part of its core. This is its current CEO, Bob McDonald, who said once, "We know from our history that while promotions may win quarters, innovation wins decades." Now, Procter & Gamble, like all companies, has its challenges. And in the early part of the 2000s, it recognized a core one. That was, despite all of its investments in innovation, despite how much it was the heritage of the company, when it actually looked at the numbers, it was having a problem. 15%. That is the percent of innovation initiatives that were succeeding, meaning they were providing a positive return against the investment that was made in them. Small. The ones that were making it through, the 15% that were succeeding, they weren't particularly big ideas. They were relatively safe, relatively small ideas. And most importantly, no was the answer to the question of, is our innovation portfolio and pipeline sufficient to deliver against our growth expectations? Over the course of the next few years, there were a series of interventions to try to address some of these challenges. Let me highlight at least a few of them, and it's a complicated story, so there's more than what's on the page here, but this at least gives you a flavor of what it looks like to attack problems like this systematically. First, P&G got very clear about the specific types of growth it was going to follow. Ultimately landed on 4 different growth strategies. Commercial innovations, where they would drive growth without changing a product, so new marketing, new promotion, and so on. Incremental sustaining innovation, the innovations, make it better, faster, cheaper, line extensions, new scents, new flavors, etc. Transformational innovations, where they would step change an existing category, like moving from 3 to 5 blades in razors, and disruptive innovations, where they would create new categories or compete in very different ways. P&G defined these quite clearly and cascaded those definitions throughout the company to make clear what it intended to do and how it would manage each of these types of innovations differently. It dramatically increased the raw materials, the feedstock for innovation, through its Connect and Develop program that works with outside scientists, and through investing in original consumer research with its Consumer is Boss program. Created special purpose groups, safe away from day-to-day business, to incubate the more transformational, more disruptive businesses. This has gone through a few iterations over the years. You had sometimes these groups located more centrally, sometimes located more within the business units, as Procter Gamble has tried to fine-tune its approach. Integrate innovation and strategy reviews. These used to be done separately. Today they are intertwined and done together. Make sure that the systems underneath this allowed P&G to make the right strategic decisions, portfolio management and resource allocation in particular. Today, P&G, at a moment's notice, can call up information about any one of the about 1,000 growth initiatives that it's working on across the globe and figure out where it is in the process, who's working on it, what the potential is, when the next milestone is, and so on. Make sure that there are tools to work or try to handle the new types of ideas that were increasingly important to P&G. Those ideas where it was creating new categories, where it knew a little and was assuming a lot. For example, P&G has found for many of its disruptive ideas, traditional market forecasting techniques don't quite work. Instead, P&G has to get into a transactional environment where it makes a little and sells a little to figure out what happens in the real world of the market. Finally, make sure that people have the skills and common language in order to do this. Invest in training programs at both senior and more middle management levels so that people really have what it takes to make the growth factory work. Now, this wasn't done in an academic sort of way. Instead, a lot of this was done in context, working on some of the specific initiatives that you see now on the bottom of your page. Some of these are new products, like the probiotic Align product on the left. Some of these are new efforts in emerging markets, like the Gillette Guard program in India. Some of these are new business models like MDVIP, personalized healthcare. Some of these are things like getting into devices like the Naked Skin offering that Gillette recently introduced that allows people to do home-based laser hair removal. A bunch of different efforts to really see how this worked and continue to improve the factory. So what kind of impact has this had? Let's look at those 3 statistics that I used at the beginning of this discussion. 15% was the innovation success rate. By 2010, that number had gone up to about 45%. It had tripled. Small projects had gotten bigger. They had just about doubled in size. You take those 2 numbers together and you've got a 6-fold increase in productivity. Most importantly, the answer to the question of is our growth pipeline sufficient for our long-term objectives had shifted from no to yes. Now, like all companies, again, Procter Gamble's imperfect. It has its challenges. It's had to continue to refine its approach. But the systematic approach to innovation embodied by this notion of a growth factory has allowed it to dramatically increase its returns on its investments in innovation. So at this stage, Dave and I have been talking for long enough, so we're going to open up the proverbial microphone, or the virtual microphone, I guess, to get some questions from the audience and engage in a little bit of a dialogue. So Evan, you got any good questions that have come in that Dave and I can tackle?
Yes, we do. Thank you, everyone, for sending them in. The first one really is a follow-up on what you were just talking about, the innovation success rate. At P&G, it tripled, went up to 45%. So someone asked, do you think it's a worthwhile goal to boost your innovation success rate even higher than 50%, to something like 90%?
Well, I'll start with some perspectives, and Dave, you might have some other ones to add on. My own point of view on this topic is that if you ultimately were to try to get your innovation success rate to that level, odds are very high that you'd be doing a whole lot of incremental, everyday, very safe sorts of innovations. Now those are a good piece of any balanced portfolio of innovation efforts, but in fact, given the uncertainty that characterizes the more disruptive, more transformational efforts, you should expect that a fair number of those are going to fail. And that's okay as long as you've got the right portfolio in place, you've got the right resource allocation systems in place, so you don't spend too long or too much money in ideas that ultimately don't have commercial impact. So I honestly think 50% is a pretty good number, and I don't think you really want to get any higher than that. But the ultimate target depends a lot on your growth types and your innovation strategy. So Dave, what else do you have to say about this?
I agree with Scott entirely. I think if you're trying to push your success rate any higher than that, it probably suggests that you're not doing enough experimentation and even taking enough carefully controlled and managed risk that you need to take as you're pursuing more disruptive and transformational type of opportunities.
That's great. Someone has a follow-up to that already. What does a company do with the 55% that are failing? How is learning from failure being institutionalized?
This is Scott. It's another great question, and an area where I think the world still needs to get better at this. I think we understand now more conceptually about how to handle failure, which is, number one, recognize that failure isn't always failure. We had an idea, we well documented the assumptions, we've gone and run our experiments, and it turns out our assumptions were wrong. There's uncertainty in innovation, so that's going to happen sometimes. So the learning we got out of this effort isn't bad. It just means we didn't hit our original commercial intentions. So that's the first thing, people recognizing that failure is not a dirty word. The second is really trying to study it and trying to understand what comes from it. The military is really good at this. Not everything goes the way you expect it to go in the fog of war, but the military has the discipline to always do after-action reviews, not blaming people in most cases for what happened, but try to understand root causes for why what you expected to happen didn't. So the more you've got this discipline to accept that it's part of the process, the more that you study it and see what you can extract from it, the more you can recognize that these are quite valuable investments and quite valuable learnings.
And when you do have something fail, and you've tried it, you've taken a run at it in a systematic, controlled way, and you've realized that it's not a good opportunity, that can be incredibly liberating, because what we often see in companies that are looking to find new sources of growth is there'll be some themes or ideas that have been kind of kicking around for years that people think, oh, we should go explore that, but there's never been a kind of systematic approach to exploring it, and then if it turns out it's not a good idea, then just killing it and moving on to the next thing, that can give you a great level of focus, which is very empowering to people.
And so just to build for a second on what Dave said before we turn it back over to Evan for the next question, you heard here that it can be liberating, it can be empowering. What happens when you're not in this culture? One of the big risks that you see is what we call zombie projects. That is, everybody's so afraid of being part of an effort that didn't succeed that projects never get shut down. They just limp along. They're the walking undead. Everyone knows that they're not going to move the growth needle, but no one is willing to put the project out of their misery. Rita McGrath from Columbia has done a lot of great writing about the right way to disengage from projects. And if you do it in the right sort of way, it can be a very empowering moment for a company. You can move on to the next effort, etc. If you don't, you have the plague of the zombie projects, sometimes resource escalation where you throw good money after bad, and all sorts of bad things creep into your system. So it's a really important topic for us all to keep thinking about. Evan, what else you got for us?
Well, a few people have asked, can I get a recording of this webinar after? And definitely yes, you'll be getting an email about how to download it and share it with colleagues. We did get a question about what are the ways to change behavior, the incentives to get rank and file people to change what they do so you can open up innovation, not only within the company, but open innovation from outside the company.
Yeah, so I'll get started and Dave will add on. So I'll make 2 points here. The first point is when you think about the incentives themselves, a lot of people think about the financial side of it and what happens when things go well. And it's important to think about those things, but I think it's just as important to think about the penalties that you dish out when something doesn't deliver against expectations. In many cases, inside organizations, if you fail, if you have something that doesn't deliver against your original commitments, you get this scarlet F pinned to your chest, no one ever wants to work with you again, your career gets sidetracked, et cetera, and then people wonder, why aren't my people taking any risk? So I think you've got to blend together thinking about the positive incentives and what you do when things don't go well. The second point that I'd make, and I realize now I have 3 points, so I'll make my 3 points and give it to Dave. The second point that I would make is leader role modeling, I think, has big impact on these things. If you go back to the Procter Gamble example, one of the programs that was instituted, this Consumer is Boss program, was an effort to get the company to reorient itself towards the marketplace, with people spending more time in the market, working alongside consumers, shopping with consumers, really understanding them at a deeper level. This wasn't something that the top leadership team just talked about and told other people to do. It was something that everyone in the organization, from the chairman down, would do on a regular basis. People don't just listen to what leaders say, they watch very carefully what they do. So if you're trying to change the culture, having new behaviors is absolutely critical, demonstrated by the leadership team. Final point that I make would draw on some of the research that's recounted in Daniel Pink's excellent book, Drive. And what he notes in that book is research that shows when you are working on a creative task, if you are given a financial incentive, your performance on that task actually goes down. Let me say that again. Working on a creative task, given a financial incentive, your performance goes down. Instead, what Pink suggests is that we ought to create room for people to develop mastery, so that they can learn new skills, have autonomy where they can control the things they're working on, and feel like there is a sense of purpose to what they're doing. If you can get mastery, autonomy, and purpose in your incentives, you can motivate amazing things from your employees. So Dave, those are my 3 points. What else would you like to add on?
I have 3 points as well, wrapped in a single larger point, which is that all of those things that relate to incentives, role modeling, and the human component are critical, but they're not sufficient, and this gets back to the notion that you really need to put a system in place. And because you can focus on interventions or changes that address only that culture talent component of that innovation system framework we shared earlier, but if that isn't reinforced and aligned with the other 3 components, with your growth blueprint, your production systems, and your governance and controls, then even if people are personally incented to do something different and they've got the right role modeling and skills in place, they'll hit a brick wall. And so the 3 points I would make are thinking about each of those other 3 components of the growth capability, the innovation capabilities framework we shared, and how they can either inhibit or reinforce the cultural and behavioral outcomes you're trying to create. If someone is incented to pursue a different type of idea than maybe what they otherwise were thinking about, if the growth blueprint is a good one, and if it answers all the questions it needs to answer, then that person can clearly see, and the team around that person and the leaders around that person can see how what they're going to do fits into the bigger picture, because it clearly aligns with one of the types we're going to pursue, and it clearly is oriented towards one of our strategic opportunity areas, and it falls within the guidelines and boundaries that we've established as part of our blueprint. We'll talk about that a bit more in a moment. If you think about from the perspective of the production systems, well, a lot of times what we see is people just who are passionate about a particular idea doing it in their spare time. They're doing it kind of on top of their day job. And there needs to be a way for ideas like that to be picked up by a kind of production system process. And if that's not in place and that doesn't support what the individual is trying to do, then it's going to be a real uphill battle. And then finally, in the governance and controls dimension, there needs to be a mechanism for people who have passion around a new idea to elevate them to a place where they can be considered for real resources to be allocated to them. Or again, it's just going to, despite your best intentions, despite all the role modeling in the world, they're going to hit a brick wall.
And ultimately, if you don't have ideas translate into innovations that translate into impact, people get very cynical very quickly. So I think
right.
Great points from Dave. So let's take maybe, Evan, one or two more, and we'll turn back to the slides.
Yeah, a couple points of skepticism, actually. Someone said most big innovations that we know about are associated with startups, new entrants like eBay, Amazon, Google. How does a big company have any chance against these guys? And the other point I think is related. Not every company has an A.G. Lafley, who's a real champion of innovation at a large company. What are your suggestions or techniques to convince leadership to invest in innovation, take risks, and fund these ideas?
Wow, those are two questions that we could spend all day talking about. So let me provide some very quick thoughts about each of those, and then Dave will add on his usual great insights. On the first, the small entrepreneurs versus innovation inside large companies, there's clearly a lot of powerful things that are done by startup companies. That's going to continue. I made the case in an article that I had in the Harvard Business Review in September that we are entering into potentially a new era of innovation where the big corporations have a chance to do something that historically seemed elusive to them. It's a weird paradox because innovation is incredibly accessible today. It's incredibly affordable. We have a small venture capital arm that we run out of our Singapore office where we're evaluating investment proposals, and we regularly see new businesses, not business plans, but businesses that have functioning websites and customers and revenue that have been funded essentially by the founders with credit cards, $200, $500, $600 worth of investment. And you might say, well, Scott, you just gave me this statistic that has proven my point. There's no way a big company can compete. It is true, a big company cannot be faster than the marketplace, but there are certain things that the startups struggle with. They struggle to create defensible competitive advantage. Look at what's been going on with Groupon over the course of the past 6 or 12 months. Andrew Mason just leaves as CEO last week as that company really struggles to figure out sustainable competitive advantage. The large companies already have it. They've got the unique, difficult to replicate assets. They can never be faster than the market, but they can be better. They can do things that no one else in the world can do if they take those difficult to replicate assets and combine them with just enough entrepreneurship. We could talk a lot more about this, but that's my thought on that topic. On the second topic, what do you do to convince your leadership? I'd ask you to hold that thought until we talk about one of the frames that we've found to be very helpful when we're creating a growth blueprint, which is what we call a future back view of strategy. That approach we found to be a very helpful one to get a leadership team aligned around the way it needs to think and act differently if it is going to grow in increasingly uncertain environments. So in about 12 minutes or so, when we're going through the future back strategy, hopefully it answers that question a bit. Dave's going to add some thoughts now.
Well, what I would suggest is that we move on to the next topic, and then I'll refer back to these questions as we go through it, because I think it largely relates to this question of how do you get people convinced they need to do something.
Outstanding. So we're going to go back to the slides now. We will have another break for questions, assuming that timing tracks the way that we expect. So if you have more questions, continue to send them on as we go through the webinar. And Dave Duncan.
Great. So and we'll get right back to that question that was just asked, because we wanted to focus a bit more time on really the foundational element of that growth factory system that we've described before, which is the growth blueprint, because this is really the most fundamental framing for everything else that you're trying to do, and break down a little bit what the different elements of it are. The first thing that you need to have a well-crafted growth blueprint is a clear definition of what your types of growth are going to be. Where is growth going to come from? And we often use this interchangeably with the idea of establishing a common language in your organization for talking about innovation and growth. Innovation is one of those words that means 100 different things, and everybody walks around with a different definition of it in their heads. But if you believe it's foundational to your future success, it's very helpful to define exactly what you mean by it. In particular, you need to define a type of growth that looks like what you do today, and then at least one other type that's going to look significantly different than who you are today, that's going to extend you into different business models that stretch beyond who you are today. And Scott went through P&G's type. They have four types, but that's really the first step. The second component of the growth blueprint is then once you've defined at a high level the types of growth you're going to pursue, you then need to get quantitative about it and assess relative to our growth goals over the long term, how much growth do we see coming from our core businesses, from incremental growth in our core businesses to things that we might define as adjacencies, and then from something else. And this would typically be associated with those non-core growth types that you've defined. And back to your question about how do you get leaders to care or to think that they need to do something in this direction, it's very enlightening when you start to, and motivational when you start to really quantify what your growth gap is. And you look at even the growth that is implied by your current valuation, just to stay at the value you are today, there's a growth rate, expected growth rate embedded in that. And when you compare that to how much growth you truly believe is going to be derived from your core businesses, there's often a fairly significant gap. And if you follow the logic, really the only conclusion you can draw is your value is either going to decline or you have to find some new source of growth. And this is often a line of thinking that can be galvanizing for leaders. Scott, did you have
I just want to just add one small thing here. I absolutely agree with what Dave has said here. And the thing that we have found in our experience is most companies have a growth gap and they don't recognize they have a growth gap. So having this be made clear, even sometimes through pretty simple analysis, as Dave said, can be incredibly galvanizing. So they might be fine for the next 1 or 3 years, but you look further out and there are just some gaping holes that need to be filled.
So once you've defined the types of growth you're going to pursue, what that means in terms of a target portfolio that cuts across those different types, the next thing that we recommend you establish as part of your growth blueprint is what we call guidelines and boundaries. And we'll talk a little bit more about that in detail. But the basic idea is that if you know some portion of your activities needs to stretch outside of the business models that you're in today, then the question is, well, how far are we willing to stretch, and what are we not willing to do? This is, again, a question that if you were to do a poll of a typical leadership team with 20 people on it, you'd get 20 different answers. And that makes it very challenging for the organization to be aligned around the pursuit of new sources of growth because there isn't a common point of view about what you're willing to do and what you're not willing to do. This is, again, to refer back to that question, the type of a discussion and analysis that can be very helpful in getting a leadership team to have some more greater degree of energy around pursuing innovation and new sources of growth. The next thing you then need is some fishing holes, some areas to go pursue new growth. And Scott's going to talk a little bit about some approaches for identifying those things. And then finally, you need to translate all of that into a rigorous and very clear kind of train schedule for how that growth is going to be realized over time and how that stacks up against the resources you're going to need to allocate over time to pursuing those things. We know a lot about what some of the success factors and pitfalls are when you're trying to create a growth blueprint. Some of the most important things are to ensure there really is a clear, consistent language that cascades through the entire organization. And I can't emphasize this strongly enough. It's one of those things that I think we often will hear leaders kind of nodding their heads and saying, yeah, that's important, we need to do that. But it's so important to get the language right and to take embedding it and really having people internalize and understanding it really seriously, or because otherwise, just confusion reigns in so many ways. The second success factor is that as you think about that quantitative perspective and what your target portfolio should be, you need to think about what the gaps and goals are, both from a bottom-up and a top-down perspective. And all we mean by that is if you think about at a high level what your growth target is over the next 3, 5, 10 years, and you establish a gap, you then need to make sure as you then go out and develop your detailed plans in each of your lines of business that rolls up to fill that gap. And then finally, we advocate using this kind of future-back methodology as a way to figure out what the great opportunities are tomorrow, and Scott will talk a bit more about that in a second. And finally, just a couple of warning signs that we see in this area. You often see the lack of any language or definitions, or ones for which there's a lot of room for interpretation. Right? Somebody might define a very kind of high-level generic definition of innovation or what kind of growth they're going to pursue, but people don't really know what that means, so it's important to be pretty specific about that. We often see people defining growth goals that assume that the world is going to continue to look like it has in the past, which we've already asserted is not likely to be the case. And then finally, just a lack of sharpness around what the strategic priorities are, and this idea that, well, we're open to anything. You know, we don't. You know, it's people will sometimes say, well, it's counter to innovation, the idea of putting constraints around what you're going to do. But in fact, the opposite is true. Constraints are extremely enabling and enable people to focus their innovation energy as opposed to have it kind of scattered around everywhere. So at this point, we wanted to do another just poll of the audience. And it relates to this idea of the growth blueprint. So we'd like to just ask you, what is the biggest obstacle in your organization to creating a strong growth blueprint? And we have a set of options here. We'll just give you a little bit of time to answer this question, and we'll look at the results of our poll. Great. So if people can now see the results of this quick poll that we've just done, it looks like the single answer that had the highest score is lack of clarity and strategic priorities, followed by all of the above, which is certainly consistent with our experience. And Scott will talk a little bit about some techniques for establishing clarity on strategic priorities, but that really is at the heart of what people need to address if they want to be able to effectively pursue innovation. Just one other quick point around the growth blueprint. We talked about one of the fundamental elements being this idea of the guidelines and boundaries. And the idea here is that if you are going to stretch yourself into new areas, how can you be precise about what it is you're willing to do and what you're not going to do? And this is, again, a foundational thing that needs to be in place. And so the way that we advocate doing that is you first define the dimensions that would characterize any new growth business that you might go into. This could be things like, what customer group would we target? What channels would we use? How big do opportunities have to be? How profitable do they have to be to make them interesting to us? What types of solutions will we provide? What geographies? How would we make use of our brands? Which brands would we be willing to use? How do we make money? How will we partner? And how will we take things to market? So any opportunity you might pursue could be characterized on all of those different dimensions. And then what we recommend is that you have discussions one-on-one with leaders to get their individual perspectives on, along each of these dimensions, what's a clear, what would be a kind of guidepost that would be a clear yes, then one that might be discussable, but it would depend on the specific idea, and then what would be a clear no. And then bring those leaders together to have a group discussion to work out areas where there's disagreement, and then summarize those results and share them with the rest of the organization. And this really is very empowering because it then gives everybody a common lens through which to view where you're willing to stretch, what you're not willing to do, and it ends up saving you a lot of time down the road because teams won't go off and pursue some idea that is violating somebody's unspoken boundary and find out after they've exhausted a lot of time and resources there. And enables you to make choices, right? So there's a nice quote from Tim Cook, the CEO of Apple, which is, "We believe in saying no to thousands of products so we can really focus on the few that are truly important and meaningful to us. And this type of an activity and an analysis enables you to do that in a precise way.
And this is something that it doesn't take months to do something like this. You can at least get a starting point for goals and bounds in a good afternoon's discussion. So I'm going to present one more tool that we found helpful when creating a growth blueprint. Then Dave's going to provide some parting thoughts about how you can get started in your effort to build a growth factory. Hopefully we can get one or two more questions in, and then we'll send you on your way. And for all of you who sent in great questions that we will not have time to answer, Dave and I will do our best to answer as many as we can and post them up on the Innosight blog after this session is done. So what I want to talk about here for just a minute is this notion of future back framing. Here's the basic idea. When we approach strategy traditionally, even though we don't intend to do so, we follow very present-forward approaches. That is, we assume tomorrow looks like today, the day after tomorrow looks like tomorrow, et cetera, et cetera. And what we end up doing is pushing today's strategy into the future, even if changes in the marketplace mean we ought to have done something very different. So what we suggest people do is develop the ability to flip the problem and instead have what we call a future-back approach. Well, what exactly does that mean? It starts with something that probably feels familiar to most of you, looking at the trends that are taking place around your business to understand what the future could look like. This sounds a little bit like scenario planning in the beginning, but then it gets very different because your senior leadership team needs to get alignment around the future that you want to create. This is not a passive activity, it's an active one. You then get really honest, and if you've done this well, there are pretty big gaps between today's reality and the future state. You walk backwards to identify what suggests you're making good progress against it, and then you put in place a roadmap to begin implementation. It's a simple enough sounding process, but as you get into the meat of it and begin the dialogues that go around it, it can really transform the way a leadership team thinks about strategy, can open up exciting new possibilities, and can really give you a good path into the future. Here's an example of a company that found some success following this approach. If you turned on the entertainment networks of Turner Broadcasting, which is part of Time Warner, back in 2005 or 2006, what you were very likely to see was an Atlanta Braves baseball game or a rerun of Friends or a rerun of Seinfeld. This was a very successful business model at the time. However, Turner did exactly what we talked about here. They fast-forwarded to 2011, 2012, and said with all the things going on with Google and YouTube and Netflix, we recognize that just repackaging other people's content will be insufficient. They looked at what they were currently doing and said, we've got 3 or 4 things that we've got to nail to prepare ourselves for the future. We got to get better at original programming. We got to get more original sports. We got to play differently online, and we have to change the advertising paradigm. That then led to a whole series of initiatives to the point where today, if you turn on TBS and TNT, you see transformed stations where you've got vibrant, original content. You've got professional-grade sports, not suggesting the Atlanta Braves aren't professional grade, but you've got NBA basketball, you've got the entire league, and so on. You've got new advertising models and a company that is now following a very different approach because they flipped the way they approach strategy. So the two tools we talked about here, goals and bounds and future-back framing, we believe are really critical components to getting that growth blueprint right. And if you get the growth blueprint right, you've made good progress in building your growth factory. So Dave, you want to take us to close by talking a little bit about how you actually get all this stuff started?
Sure, and as a way to tee that up, just wanted to relay a quick anecdote about a company that's a very different one than P&G, which is Citigroup. And if you recall, back in December of 2007, Vikram Pandit took over as the CEO after Citi reported surprisingly disappointing third-quarter earnings. And these disappointing earnings were an early sign of the financial crisis that hit the global economy with full force in 2008. And one of the first things that Vikram Pandit did was to commission an in-depth look at Citi's current situation. What are our strengths and gaps, and what's gone wrong in recent years. And he asked this gentleman here, whose name is Don Callahan, who's the Chief Administrative Officer of Citi, to meet with Citi's advisors and to try to understand the situation. And when they came back together, Vikram asked him, what did you learn? And Don said, well, we've lost innovation. It's worse than we thought. And Vikram's answer was a very simple, straightforward one, which was to get it back. Because he recognized that if Citi wanted to survive and thrive in the future, it really needed to urgently reestablish innovation and the growth that results from them as a core focus. And it wasn't that they didn't have other things to worry about, but in Don Callahan's words, everything else we were trying to do was so important. But we knew if we didn't focus in on innovation, we would not be able to return Citi to the proper heights. And so they kicked off a number of things. And I would just like to generalize from that and talk about 3 ways you can get started if you're trying to create this kind of system that we've been talking about. And you certainly can't do it all at once. It typically involves such a degree of change that you can't do everything at the same time. 3 good ways to get started are, number 1, create a common language. In the case of Citigroup, they defined 3 different types of growth they wanted to pursue, which they called core, adjacent, and disruptive. And they've started to embed that into the way they think about innovation portfolios and investments. At P&G, we've already talked about the language that they've created. A second way to get started is to do a detailed look at your current state in light of those types of growth that you're going to pursue. How big is your growth gap? And do a kind of a diagnostic of your innovation system today. And we have some helpful, I think, diagnostic tools that we'll share with you here towards the end that can be a way to start on that. And then finally, as you act on a roadmap to build out your system over time, use demonstration projects to build confidence and pinpoint issues. So we don't advocate typically just designing a process and structure and spending a lot of time on that in the absence of trying to road test it through application to a real demonstration project. That's a way you can kind of design the plane and build it and fly it at the same time so that you're optimizing it and hopefully having real impact at the same time as you're putting that structure and system in place.
So fantastic thoughts from Dave. So we are running short of our hour-long time together. We have gotten a ton of great questions. Again, we'll answer many of them offline. Evan, do you get one that you think is a great one for us to close out on before we tell you how to learn more about this?
Yeah, this is a really good question about getting consensus. Everyone can see that there's a problem going forward in your growth gap. There could be a revenue shortfall in the future. But how do you form a reasonable consensus on what those growth gaps are? What areas should you address?
So I'll offer a couple thoughts up and then would be curious to hear Dave's thoughts as well. The first thing I would say is one of the best things to do is to not do this in the next 1, 2, 3, or 4 years. Instead, take it far enough out that no one feels like they're being personally attacked. So if you go and look at the company 5, 7, 10, in some industries we've even gone 30 years out. You go a little bit further than the present reality, no one feels like you're pointing the finger at them because they're not delivering what they need to deliver. The second thing I would say from our experience is it has to be a very dialogue-intensive activity where people are having discussions in front of each other, where they diverge and converge. And usually when this works well, there are periods in between the dialogues where you might say, here's all the future trends that are taking place. Everyone talks about them. Do we agree with these? All right, let's go work on it for a little bit to see which ones of these we think are most critical. Then let's get back together and talk. So this diverge-converge cadence we found to be really important. And the third is to recognize that you're never going to get everything precisely right. So try to figure out what might be testable assumptions where you can launch some probative experiments to figure out if you're uncertain about an area, which you think is the right answer. So those are my thoughts on how you build consensus around growth gaps. Dave, what would you like to add here?
Yeah, the only add I would have is that when you're having those discussions, it's important to introduce into the lexicon the idea of fact versus assumption. So as people are talking about their beliefs in one point of view versus another, asking people to get very precise about, well, what do we know is a fact, and what is just an assumption that we're making? And for the facts, how much evidence do we have? What is the evidence that we have to back that up? And having people frame the debate in those terms can be very helpful way to move people forward and get to consensus.
And the research would show, great point by Dave, the research would show we are way overconfident in trying to, when we try to assert or try to assess how much we actually know about things. And if you're honest about it, what you truly know is not that much. So great ending point from Dave. So Evan, you want to send us on our way?
Yeah, we had great participation and a lot of listenership showing the interest in this topic. On behalf of Scott and Dave and Innosight, we're grateful for your time and attention today. You'll get an email when the recording is available, along with the slides, and we welcome you to contact us through Innosight.com. Scott and Dave would also welcome hearing from you via email with the addresses on the screen. Their ebook, Building a Growth Factory, is on the Kindle and on the iPad through iTunes. You also have the Building a Growth Factory app in the App Store, which is actually different, where you can get hands-on tools to help you with your innovation strategy and practice. And you could also follow